Welcome to the weekly Heads Up for New Zealand business from DAA Business Consultants and Chartered Accountants.
Tax avoidance, back in the news again, Neville.
Rob, yes, IRD have just released, after 8 years of trying, their interpretation statement. Got some bombshells in it, I've got to tell you. We've got, based on the Penny and Hooper case, which we've all heard about, the two Christchurch surgeons, we've got now this test of what Parliament was contemplating when they wrote the law or passed the law. Some very far-reaching stuff there.
When is it likely to become law, or do we get access to submissions?
Yes, we do. It's in draft form only. 8 years and it's still in draft form. So the submissions are called for and they're due in by the 31st of March. And I've really got to suggest that everybody needs to get into this because it's so far-reaching.
This isn't evasion, this is avoidance. They used to be separate.
They used to be two different things, but in New Zealand law these days, it's only a matter of a different penalty that will apply. So we come back to Inland Revenue and how they view it and how they police it, and they are actively doing both of those things. So it's going to be something that will have a big impact on the whole New Zealand community, not just the business community.
How can you as a chartered accountant be expected to know what the government or the court intended?
It's worse than that. I agree with you. We cannot. I don't believe. No doubt some lawyers would take issue with it, but we can't. And IRD put that test on the taxpayer themselves. In this statement, they've come up with 6 or 5 in a summary tests that any arrangement has to meet. And they are, first of all, that the taxpayer fully understood all of the ins and outs of that particular arrangement. The taxpayer has to have gone through the relevant provisions of the Tax Act, both those that they are avoiding and those that they might not be. They have to assess the commercial reality of the arrangement. And the fourth one, they have to assess the economic effects of the arrangement. And the fifth one is the killer. They have to ascertain what Parliament's purpose would have had on the arrangement that they're contemplating.
And I expect they need a PhD in rocket science.
They're certainly going to need us or our equivalent, that's for sure.
What does IRD expect?
You don't mean just more tax, Rob. IRD expect that people will not get into these sort of arrangements. Now the difficulty is that any arrangement or scheme which alters the incidence of income tax, and that's what this is all about, something which alters the incidence of income tax. It's not even a matter of not paying tax, it may be just a matter of reducing your tax. Any scheme along those lines is going to be vulnerable to this sort of interpretation by Inland Revenue. Now that could be a simple matter of how you choose to invest your money. So it's far-reaching.
You're implying there about these pie schemes?
Well, that could be a case in point. It would be an arguable one, but it could be a case in point because, after all, some people have been encouraged by the government wearing a different hat to invest in pie-type investment schemes because it has a lower rate of tax for that particular taxpayer. Could that be caught by this? We won't know. We'll have to wait and see what Inland Revenue's view on it is, but nominally on what I've read out of this interpretation statement, yes, it could be caught.
Would be very timely to get hold of DAA, wouldn't it?